Here's what they're not telling you. Gold just dropped 2.1% to $2,040, while silver dumped another 4%. And the reaction you're seeing across mainstream finance media is completely disconnected from what's actually happening under the surface. Everyone's calling this a metal sell-off, a risk-off move, a dollar bounce story. But if you actually read the tape, if you actually track the flows, if you actually understand the difference between paper price and physical demand, this move looks very different. In the last update, I told you that the metals complex was sitting at a fragile technical inflection point. I said if gold loses the 2060 area and silver loses its short-term support band, we could see a fast liquidation flush designed to trigger stops, shake out weak hands, and reset positioning before the next major move. That's exactly what happened. Gold sliced down through $2,060, tagged $2,040, and silver got hit harder as usual, dumping 4% in a matter of hours. But here's the key detail everyone's ignoring. The move happened on thin volume during low liquidity hours with disproportionate selling pressure in paper futures relative to actual physical outflows. That's not organic selling. That's positioning. That's leverage. That's the kind of move you see when large players are pushing price into liquidity pockets to trigger forced selling. And if you don't understand that dynamic, you're reacting emotionally instead of reading the structure. Current prices as I'm recording this. Gold Western Spot hovering around $2,040 after the drop. Silver Western Spot just under its recent consolidation range after the 4% slam. Futures spreads widening slightly, but not showing the kind of panic you'd expect if this were a genuine collapse in physical demand. That's the first clue. When price drops hard but premiums and spreads don't collapse in tandem, you're looking at a paper-driven move. That doesn't mean price can't go lower. It absolutely can. But it does mean the narrative of collapsing demand doesn't match the data. And that mismatch is where opportunity and risk both live. If you're actually learning something from these breakdowns, if you're verifying the numbers instead of just reacting to headlines, drop a comment with the word metals below. It tells me who's paying attention and who's just scrolling. Because this channel isn't about hype. It's about understanding how these markets actually move. And if you're not following the real-time updates, you're missing half the picture. These moves happen fast. By the time mainstream media explains them, the positioning is already set. Now let's talk about what actually triggered this move. The first catalyst was a broad risk-off wave across multiple asset classes. Equities dipped, yields moved, and the dollar caught a bid. That combination tends to pressure metals in the short term, but the magnitude of the drop in silver relative to gold tells you there's more going on. Silver is a smaller, more volatile market. It's easier to push around with leveraged futures. So when you see silver drop twice as fast as gold without a corresponding collapse in physical demand indicators, you're likely looking at a positioning flush. The kind of move designed to trigger margin calls, force liquidations, and reset the board. Open interest data shows a modest decline in short-term contracts, but not the kind of mass exodus you'd expect if investors were abandoning metals. Instead, what you see is rotation. Contracts closing in the front month, reopening further out. That's not panic, that's repositioning. That's traders rolling exposure while waiting for clearer macro signals. And that brings us to the macro backdrop. Inflation data, central bank expectations, and dollar strength are all converging right now. When traders anticipate tighter financial conditions or delayed rate cuts, the dollar strengthens and metals often dip. But here's the nuance. These dips often happen before the macro narrative actually shifts. Markets move ahead of data. They price in expectations, and then they reverse when reality doesn't match the fear. Technically, gold losing $2,060 opened the door to a test of $2,040. That level was always a potential magnet, not because it's some magical number, but because it's where liquidity clusters sit. Stop orders, short-term support, options positioning. Once price breaks into that zone, it accelerates, not because fundamentals changed overnight, but because the structure allowed it. Silver's 4% drop followed the same pattern. Break support, trigger stops, cascade lower. But here's what matters now. Do these levels hold, or do they break further? That's the question the market is asking. Not whether metals are dead, not whether demand vanished, but whether this flush achieved its objective. Volume analysis shows the selling spike happened quickly and then tapered off. That's typical of a liquidation event. Sharp move down, then stabilization. If this were the start of a sustained collapse, you'd expect continued heavy selling, expanding volume, and widening spreads. Instead, what we're seeing is a pause. That doesn't guarantee a bounce, but it does suggest the initial shock move may have done its job in clearing weak positions. And when that happens, markets often stabilize before choosing a direction. Another layer to consider is physical demand in the East. Premiums in Asian markets haven't collapsed in line with the Western paper drop. That's a key divergence. When physical buyers step in as paper price falls, it creates a floor. Not immediately, not perfectly, but structurally. It means there's real demand absorbing the selling. And that's why you can't just look at the chart and assume the trend is dead. You have to look at the flows. Now let's talk about sentiment. Every sharp drop in metals triggers the same reaction. Headlines declaring the end of the bull market. Analysts calling for deeper corrections. Retail traders panicking. But sentiment swings faster than fundamentals, and the best opportunities often appear when sentiment and structure diverge. That doesn't mean blindly buying dips. It means watching how price behaves after the flush. Does it stabilize? Does it reclaim key levels? Does volume support a reversal? Those are the questions that matter. The dollar's role here is critical. A stronger dollar puts pressure on metals because they're priced in dollars globally. When the dollar rises, metals often dip. But dollar strength driven by short-term positioning can fade quickly. If the macro data doesn't support sustained tightening, the dollar rally can reverse. And when it does, metals often rebound. That's the dynamic playing out right now. Traders positioning for a certain macro outcome, markets reacting, and then potentially reversing when reality settles in. From a risk management perspective, this is where discipline matters. You don't chase falling prices. You don't assume immediate reversals. You watch key levels. For gold, the $2,040 zone is now a battleground. Hold above it and you could see stabilization. Lose it with conviction and you open the door to deeper tests. For silver, the recent support band now becomes resistance. Reclaim it and structure improves. Stay below it and volatility continues. These aren't predictions, they're scenarios. Liquidity conditions across markets also play a role. When liquidity tightens, assets that rely on leverage can move violently. Silver, being smaller and more leveraged than gold, reacts more aggressively. That's why you often see silver overshoot both up and down. It exaggerates the move, and that exaggeration can create opportunities for those who understand the pattern, but only if you stay disciplined. Now consider the broader trend. Despite short-term drops, gold remains in a longer-term uptrend, driven by central bank demand, geopolitical uncertainty, and structural shifts in global reserves. Central banks have been accumulating gold at elevated levels. That doesn't change because of a 2% drop. It's a long-term trend. Silver's role as both a monetary and industrial metal adds complexity. It reacts to economic expectations as well as monetary factors. So when markets fear slowdown or tightening, silver can drop faster. But when conditions stabilize, it can rebound faster too. So what actually matters now? Watch the reaction, not just the drop. Watch how price behaves around current levels. Watch volume. Watch the dollar. Watch yields. Watch whether physical premiums diverge from paper price. Those signals tell you whether this was a temporary flush or the start of something bigger. The biggest mistake traders make in moments like this is reacting emotionally, seeing red and assuming collapse, seeing green and assuming recovery. Markets don't move in straight lines. They move in waves. And the sharpest waves often happen at inflection points. That's where we are now, an inflection point, not a conclusion. If this drop was purely technical and liquidity-driven, stabilization and potential recovery follow. If it was driven by a genuine shift in macro expectations, then metals could consolidate lower before the next move. Both scenarios are on the table, and the only way to navigate them is by watching the data, not the noise. Right now, the narrative of a metals crash is louder than the data supporting it. That doesn't mean price can't go lower. It means the story is more complex than headlines suggest. Gold at $2,040 after a 2.1% drop and silver down 4% look dramatic on a chart. But in the context of recent volatility, they're within the range of normal corrective moves. The key is what happens next. Does gold hold this zone and build a base? Does silver stabilize and reclaim lost ground? Do physical buyers step in more aggressively? Do macro signals shift? Those are the questions to watch, because markets often test conviction before making their next move. And this drop looks like a test of support, a test of sentiment, a test of positioning. So instead of reacting to the shock, observe the structure. Instead of assuming collapse, watch the response. Instead of chasing headlines, follow the flows. Because the ones who understand these dynamics don't panic during volatility. They prepare, they watch, they wait for confirmation. This isn't about predicting the exact bottom or top. It's about recognizing when moves are driven by structure versus fundamentals. And right now, this looks like a structural move amplified by macro positioning, not a collapse in underlying demand. That distinction matters because it changes how you interpret the drop and how you position for what comes next. The metals market thrives on volatility. It shakes out weak hands, it rewards patience, and it punishes emotional decisions. Today's drop is another example. Sharp, fast, attention-grabbing, but not necessarily definitive. The real signal will come from what happens after the shock, whether price stabilizes, whether buyers step in, whether macro conditions align. Until then, the smartest move is observation. Track the levels, track the flows, track the reaction, because the market always reveals its intentions through behavior, not headlines. And right now, the behavior suggests a flush, not a collapse, a reset, not an ending. Stay disciplined, stay observant. Let the market show its hand before making yours.